now for something that's going in the pipeline to be used 30 years from now, there's no present value calculation that's going to make that pass the laugh test. So some people say, oh, well, you're hoping to find an especially good ore body that gets in the queue much quicker than 30 years. You're hoping for a great discovery, but simple theory has the good stuff being discovered first and the lousier stuff generally being discovered later. And so you're playing the odds. There could still be a 6 in there somewhere, but I'm amazed that there's the amount of investment in these industries that there is, given the long-term price behavior. And you'll find that mining companies generally aren't mining the stuff and then letting it sit in inventories on the ground for long periods of time, because generally you're making capital losses on that rather than capital gains. The sovereign funds don't know if they're actually holding spot positions. So I go back to my earlier comments that if we're talking about commodities as an investment class, it's really important to distinguish spot from futures investing, and that Gorton and Roundworth's paper suggests that the rate of return for rolling futures contracts is comparable to stocks with about the same standard deviation, and the return on spot investing, even ignoring the storage and insurance, is really, really lousy over the long span. Of course, you can cherry pick individual years where it looked brilliant. Yeah. So I guess diversify and hire Roberto to write flexible contracts, humble flexible contracts.
It seemed to me the most obvious feature of at least the index that you first showed us was the change in heteroscedasticity from early period to later period. So it might be that you would want to weight these observations based on their conditional variance, and so it's a little hard to do that with these frequency domain windows. So an alternative might be to go to splines, which you could do kind of in a regression framework and do a weighting as you go. Splines would not focus exactly on the length of the cycle, but it would focus on the smoothness of the cycle, and so you would impose either a smoothness prior or sort of knots that are spaced fairly far apart so that you can't move too fast. And I think you'd get pictures which would be interesting to compare with yours.
Okay. Yeah, I don't know too much about that spline methodology, but yeah, there's quite a collection of ways, very formal and more formal, for putting smooth lines through data, right? And I think all of them, there's this fundamental criticism, well, what if you do this with a driftless random walk, and trying to square that with a presumption you're dealing with a series that could have evolving trends. So
well, it's a different question of whether you're going to want to test this versus whether you want to just see what the best looking line is.
Yeah. Yeah, indeed. The earlier econometric literature that was estimating trends, they were typically then testing to see whether the trend was statistically significant. And as I did some of the earlier work, first applying unit roots, saying you got to look at unit roots when you do that, and once you do it, you can't reject that it's zero. And then John Tilton, my colleague, would come along and say, well, just because you can't reject that it's zero doesn't mean it's zero. Your point estimate is still, and the point estimate would be maybe, 0.5% per year negative, and he'd say, well, that's your best guess. And that was what led me to do this hypothesis testing, letting it range from +4 to -4, and you can't reject any of those. So it's just, we have a profound level of ignorance about the long-term trend because of this huge volatility. Which, as you're pointing out, is even changing over time, but that just kind of squares my problem and it makes it worse. Yeah, the pictures, I have files that do this sort of analysis, just calculating the logs, the D logs and the DD logs for all of the 100 series, and there's remarkable variation in the heteroscedasticity pattern. So if you look at aluminum, it goes like this, and then it's very low volatility, and then it's big. It looks like a barbell. And I'm conjecturing that the smooth part in the middle was probably when Alcan and Alcoa were the two dominant players. And this was before there was LME trading. And of course, with some of these, you can associate the rise in volatility with the onset of trading in formal markets, whereas many of these are still producer price. There's no formal trading mechanism.
Okay, thank you for this magnificent talk. I would like to ask your opinion and the experts in the room. So you look at the long time series, and it is extremely useful and important because you can relate to fundamental papers. But at the same time, I would argue modestly that we are facing a shift in paradigm, like a physical system which is completely changing face as far as the world of commodities is concerned. From my modest perspective, I go to mining companies' conferences, and they are magnificent, like finance conferences 15 years ago when bankers were dancing. Now mining companies are, and not only are they dancing, but rating agencies give them an excellent rating, and we believe that these people eventually have some knowledge. And also, I would refer to a gentleman by the name of Jeremy Grantham. GMO is a fund, a hedge fund, $100 billion under management. This gentleman is remarkably wise. A year ago, he produced a paper precisely proposing the shift in paradigm in the world of commodities. And this year, he has one paper a year, one publication, and this year is not only going further in the shift in paradigm, recognizing commodities as a crucial asset class in their own right, and this year he recognizes food as a very worrisome piece of the picture. So my scientific question to you, and returning to the question on stochastic processes, which was my first life, is that how can we get some feeling for the stochastic process coming in, let's say, the next period, if we are between this shift in paradigm that I deeply believe in, looking at data like yourself going far away, and the fact that something happened at some point in the early 2000s that eventually those producing commodities decided that's it. We don't want this declining trend, and it is not going to take place for 100 years anymore. So what do we do in terms of proposing some model for the price process?
I'm not sure if all that came through at the back or not, but in terms of the shift in paradigm that you're referring to, is it the commoditization of the exchange trading of these commodities that you're referring to, or something that's...
I believe it is a small part of the story. Some of my PhD students are working on high-frequency data and so on. To me, it is a small piece of the story, the easy one for people coming from finance. I think the big piece of the story is that when you are a developing country or a developed country and you are producing commodities, you want to be rewarded for your risk, you want to be rewarded for the cost of extraction, you want to pay the human beings who work with you, and this cannot hold anymore. This can't be true for the next century. That's the shift of paradigm as modestly expressed by me and expressed by Jeremy Grantham. I can send you the paper if you will.
Yeah. So I guess the starting point for my descriptive analysis here is the paradigm's always evolving, right? You have depletion, you have new technologies, there's this tug of war, and you can always come up with additional things that are happening. There, for example, molybdenum and cobalt didn't used to be traded on a formal exchange. Borax still isn't. But now those two commodities are traded on the LME. By the way, when I talk to people who have huge primary molybdenum mines and ask them what's the relevance of the trading on the LME, they say it's essentially irrelevant for us. And I said, yet. Okay, so this was was Freeport, and my professorship was funded by the Climax molybdenum mine, so I have a sort of an interest in following that, and I take students touring this, and I say, well, now that you have the LME, what's that doing to your pricing? And they just kind of yawn, you know. So they produce stuff, and it's shipped immediately. There's essentially no inventorying of anything. And those contractual arrangements, that's the way they do business. So when you look, moly is one of the 101 commodities in there, and that's the environment that you're looking at. When you look at something like borax, you know, I only remember borax from being a kid when there was this ad about borax laundry detergent is stronger than dirt sort of thing. But it's now used in, you know, fabricating as a component in plasma TVs and whatnot. So if you were 50 years ago, you were producing borax, it's very much a producer market. But you wouldn't even be aware that some of these things are now being used in ceramic tiles that weren't important before, or being used in cell phones. So if you look at any one of these things and say, oh, there's a paradigm shift, I'd say, well, the world's evolving. There's no reason to expect the trends to be constant. Many of these things, these materials will become economically obsolete before we run out of them. And the simple models all assume there's a fixed supply, and you'll asymptotically use it up, you know, that you won't get to a point where people say, oh, we don't need that anymore. Yeah. When you ask mineral economists for things we've run out of, they have a hard time coming up with a single example. I believe the one they point to is whale oil or something like that, but it shows you how you really have to stretch. And I'm not a whale oil example, but they basically say we ran out of whales and whale oil before that way of lighting your house was replaced by electricity. So there's a comment sort of along this line yesterday, I forget who made it, about what petroleum in the Middle East or elsewhere will be worth 150 years from now. I forget who made the comment, but the answer was probably it's going to be worth nothing. You know, and the Saudis certainly today are worried that technological change may undermine the value of a lot of their supposedly huge stock of very cheap reserves.
Take water. You need water to transform tar sands into crude oil, and when you are in Australia and you are desperate for water, you need energy to take the salt water from the ocean and get fresh water.
Yeah, water and energy, scarce inputs into this, and now there are people that saying, oh, the ultimate resource is the limitation on the environmental sink we have. How much crap can we put into the world that we have? And they say, well, that might be the ultimate limitation. One of your other comments, you're looking at those downward trends in prices, and if you said, why would anybody produce that stuff when there's a downward trend in price? Well, of course, price isn't what determines profitability. You've got to look at costs, and there's been huge declines in marginal costs of production. It's quite astounding when you see the massive processing of earth to get out just minuscule quantities of the resource. So costs have fallen dramatically in the milling process, but also in the exploration and discovery. This is no longer Jed Clampett shooting his gun and up from the ground comes a bubbling crude. You know, I mean, we've got very sophisticated aerial reconnaissance ways of looking at the geology and sophisticated statistical ways of doing a detailed assessment before you spend billions of dollars on the project. So it's a neat question. You say, why would you be so stupid as to produce aluminum when the price is falling like this? But the answer is, well, the costs have got to be falling as well. And I view that as the ultimate reconciliation of what's going on in the hoteling theory. Presumably, the hoteling theory is telling us about an intertemporal arbitrage condition, and so we should be reluctant to say, oh, well, we don't believe that's right. Rather, we should say, well, there ought to be something where the shadow cost cost value of the stuff in the ground should be changing at a rate that's equal to the change in the price minus the change in the marginal cost. So until we have detailed information on what's happening to the marginal cost, we don't want to claim that hoteling got it wrong. And the casual discussions I have with people on marginal costs is that it's falling dramatically. And we do have consulting shops will give you data on cost curves, and they have moved down dramatically over time, even though we're moving to poorer and poorer quality ore bodies, you know, so that either there's less ore per ton of rock, or you've got to go to some obscure location to get the stuff out, and yet costs are falling.
Thank you.
No further questions? Okay, thank you very much for your attention and comments.
Okay, thank you very much. It's a pleasure to be at this great conference, and I thank the organizers for their hard work in making this a very successful event. This is joint work with Paolo Pesenti, and before I start, I have to put up the usual disclaimer when you're at the Federal Reserve. So everything what I'm going to say is my opinion and not the Federal Reserve System or the New York Fed. This paper is similar to the papers that were presented in the first session. It's about forecasting commodity prices. And in case you need any motivation of why we actually should be interested in this issue is, well, let's go back to the Bernanke speech in June '08, where he emphasized the importance for policy of, properly forecasting commodity price changes and understanding the factors that drive those commodity price changes. And of course, commodity price swings have been quite spectacular in the recent period. So at the time of his speech, the oil price more than doubled between the end of '06 and when he made the speech, and food prices over the similar period rose with about 50%. And at that time, inflationary pressures were very much on the mind of monetary policy makers across the globe. And of course, with the Lehman disaster, trade almost collapsed worldwide, and you had a plunge of commodity prices, the rise of disinflation or even deflation, and afterwards, again, a sharp recovery in commodity prices. So that's enough of a motivation actually to do some solid work on trying to forecast and understand commodity prices. Commodity price forecasting is quite important in policy institutions. So central banks across the globe actually are putting a lot of resources in trying to forecast, for example, the future oil spot price or the IMF commodity price index. And usually they use future prices. So it's based on the assumption that future prices are kind of an efficient way of aggregating all kinds of information that's out there over about global economic conditions. And usually they use a model, something like this, where you assume that you can forecast the change in the spot price over a horizon with the current spread in the future price over corresponding maturity and the current spot price, plus some error term, which usually is something magic called judgment. But the question is, is this really the right way to do it? I mean, really, most central banks, even I worked at the Bank of England, they use something like this, and the board uses something like this. But you can argue, is this really the way to go forward? So, for example, I mean, for oil spot prices, if you look at the futures, you make a nice hedgehog chart like this. I mean, you can see that these futures are really, really biased predictors, especially since, after '04. So the question is, can we now reach some kind of pragmatic consensus about, how to predict swings in commodity prices? So our paper is an attempt to just check how close we have been in reaching that consensus. So in our paper, we conduct a horse race between various approaches to forecast commodity prices. And we're going to focus on 10 different indices of commodity spot prices. We're going to use common factor models with global economic data, and also use Ken Rogoff type of commodity currency-based models. And we try to beat, so to speak, simple statistical benchmarks like a random walk for the price level, or a simple autoregressive process for the change in a particular commodity price index. And our basic message is, well, it's very hard to actually beat these simple statistical benchmarks. I mean, whatever you do, I mean, I'm going to use really a lot of fundamental data. I mean, we're going to really have a super kitchen sink approach. It's very hard, really, to beat this very simple model. So basically, when we talk about existing approaches about forecasting commodity prices, there are more or less 3 approaches. So the first one is the atheist approach, which is basically, those are these simple statistical benchmark models. Then you have the true believers who think, well, maybe markets are efficient after all, so let's look at really market-based measures like futures or commodity currencies and see what how we can use that. And then there's the rest of us, the agnostic ones, especially me, and let's do like a kitchen sink approach, have an open mind, and see what the hell we can find out there that actually has some forecasting power for commodity price changes. So a little bit more in detail about these approaches. So basically, as I said before, the atheist approach is like simple statistical benchmark model. So one is an AR model, and we're going to basically use it in a direct forecasting sense. So we're going to regress the each month ahead change in a particular commodity price index on an intercept, and a number of first differences in the present and the past of this particular commodity price index. And we're going to just sequentially applying BIC when we roll through the data to actually select an optimal lag order in this model. The other atheist approach is just basically unconditional mean for the change in the, using the unconditional mean for the change in the commodity price index, which implies a random walk for the log of the price level. Then true believers, there are kind of 3 subgroups in there. So, you have guys, they say, well, demand is relatively inelastic. So if there are small revisions in, expectations about supply, they can have very large price effects. Then you have guys who think about, speculative strategies, especially in an environment with very low real interest rates, because then the opportunity cost of actually holding physical commodities is relatively low. So that's the Frankel stuff. And then you have like the Ken Rogoff type of approach, which is kind of intuitively very attractive. So basically his idea is, well, maybe we don't have very good future prices for commodities, but these small commodity exporting countries, you can look at if they have flexible exchange rates. These exchange rates can be a kind of a proxy for market-based expectations about future commodity price movements, because in theory, pricing of exchange rates should take into account all kinds of factors of fundamentals for a particular exchange rate. So for a commodity exporting, a commodity exporting country, expectations about, the future global demand and supply of commodities would be taken into account by the markets in pricing these exchange rates. So you can simply add changes in exchange rates of commodity economies to an AR model and try to use that for forecasting. So we're going to use dollar exchange rates vis-a-vis Australia, Canada, Chile, New Zealand, and South Africa. Although Chile is not used all the time because we don't have a very long sample available, fully floating exchange rates. And then you have the agnostic approach. There, basically, that's the kitchen sink approach. So we're going to use a very large panel of all kinds of fundamental data. So, for example, we're going to use macroeconomic time series across developed and developing economies, industrial production data, business and consumer confidence data, retail sales volumes, et cetera, we augment that with data on inventories and production of industrial metals, oil, natural gas, and coal. Of course, we're also going to add the commodity exchange rates and then add the BDI, Baltic Dairy Index. It's like an aggregate shipping rate index, which supposedly is informative about, the future state of the global economy. So how are we going to use this big chunk of data? So we're not going to use forecast combinations. The papers that you've seen in the first session are heavily relied on that approach. We're going to use factor-augmented regression. So we're going to take the AR model and add a number of common factors to the forecasting regression. And in doing that, we're going to follow two approaches. So in general, if you have like a regression where you have a large number of right-hand side variables, of course, you want to compress that so that you have like a parsimonious regression. So a very often used approach is the Stocker-Watson approach, where you have this big panel and then you extract a number of principal components. And they have a very neat, very elegant theory where they show that under certain assumptions, these principal components up to a rotation actually gives you a consistent estimate of the common factors that drive the dynamics in that panel. So that's one approach we're going to use. The other approach is PLS regression, partial least squares regression. Because one disadvantage of using principal components is that you select all the common factors from that panel that actually drives the dynamics in that panel, but not all of them are actually relevant for trying to fit something like future commodity price changes, for example. Now, partial least squares regression actually gives you a way around that by directly extracting those common factors from the panel that actually are relevant for the fit of your left-hand side variable. And the way you do that is you basically take, the dominant eigenvectors of the squared correlation matrix and use that to construct your common factors, essentially. So what that means is that the number of PLS factors can be smaller and are very likely smaller than the number of principal components-based factors. And they're kind of a subset of those principal components factors. So basically, you're only going to select those common factors, proxies for common factors that supposedly have the best in-sample fit for your left-hand side variable. So two versions of factor-augmented regressions, principal components-based and PLS-based. But then the question becomes, how many common factors are we actually going to use in those factor-augmented forecasting regressions? So there are a zillion techniques out there. Bai and Eng have a couple of criteria, but they have a tendency to really over-select the number of factors. So usually, if you apply those techniques, you can end up with like 12 factors, which is not really, in my view, resulting in a very parsimonious forecasting regression. So what we're going to use is like an augmented, like a modified version of the BIC criterion. And essentially, what we show in the paper, show in this paper actually, that for different ways of proxying common factors, you can actually just take the big criterion and just add an extra penalty term to it that actually penalizes the estimation error that comes through because of the fact that you have to estimate principal components or estimate PLS factors, because that's an extra source of estimation error on top of the actual parameter estimation. Because in a way, these common factors are kind of generated regressors, but not like in the Bacon type of manner, because when your cross-section dimension becomes really large, actually the estimation error disappears. But like in finite samples, that estimation can be particularly big. So this criterion can kind of correct for that and help you select a parsimonious number of common factors. So what is our data? We're gonna look at 10 price indices. So we look at the CRB index, both the overall index and the industrial metal sub-index. And we're going to use it from 73 onwards, and it's monthly data, by the way, because of the fact that if we go further down, this index is going back to the 40s, but that means that the quality of our panel of predictive variables becomes quite crappy. So that's why we stopped in 73. We're going to use we're going to look at the Standard & Poor's index, both the aggregate one, the industrial metal ones, and the energy sub-index. The IMF index, which is the one that's very much looked at by policymakers these days, and then the Dow Jones AIG index, which we couldn't find really proper data before 91, so we're going to use that from 91 onwards. The predictive variables, so the panels are going to vary in size depending on which spot index we're actually going to use. So in the case of the CRB and the Standard & Poor's aggregate indices, we have a cross-section index of 96 series. And if you go like to the Dow Jones AIG, we use about 143 series. We're going to re-estimate all the models sequentially using a fixed rolling window, so no expanding window, but a fixed rolling window. So just to cope with the fact, it's just a pragmatic choice, just to cope with the fact that you have instabilities in the data unavoidably. And the window is set to 10-year period. And after re-estimation, we generate a forecast across different horizons. And we report the forecasting performance in the form of a relative mean squared error differential. So basically, it's the differential between the mean squared error of the benchmark model, either the AR model or the conditional mean, minus an adjusted mean squared error measure of the alternative model divided by the MSE of the benchmark model. And the adjusted MSE measure is the Clark and West measure. And basically, as Alan has shown before, you basically subtract the square difference in the forecast, the average square difference in the forecast between the two models from the original raw mean squared error of the alternative model. And we can use it also to test for significance. We use rolling windows, so basically a simple z-statistic as a standard normal distribution, and we're going to do a one-sided test, so we're going to use one-sided standard normal critical values in this inference. So before I show you some results, let me just recap what the results are. And the winner is, well, there's no obvious winner. Information from large panels of all kinds of global economic variables can help, as you will see, but it's not really overwhelming. The Ken Rogoff school, if I may call it like that. So he has like in 2010 he published this QJE article where he really had presented a very strong result that, just using changes in commodity currencies can give you fantastic out-of-sample forecasting performance for all kinds of commodity prices. Well, we hardly find any overwhelming evidence for that, actually. So we kind of falsify this Rogov finding. And basically, there are no easy generalizations that we can make from our results. Now I'm going to discuss some specific results. I mean, the paper has about 13 tables. I'm really not going to discuss 13 tables with you, but I'm going to concentrate on 2 indices. So let's first look at the CRB aggregate index. So what's the pointer here? The pointer is oh, sorry. So these numbers here give you kind of a relative improvement or deterioration of the forecasting performance of an alternative model, be it the Rogov model, the principal components-based model, or the PLS model, relative to either a random walk or an autoregressive model. So in this case, 0.07 means a 7% increase in forecasting performance of this commodity currency-based model. And of course, a negative number means a deterioration. So if you look at these, and then in the parentheses, obviously, is the test statistics. It's not really that impressive. So for PLS regression at the short horizons, like 1 month and a quarter ahead, I mean, at itself, these are pretty large numbers. Like a 20% improvement is quite impressive. 40% also, but that, again, that's not significant. And if you look at the commodity currency-based stuff, there are 2 significant results at the 1 month and the 2-year horizon, but even though they're significant, they only indicate like a 7% improvement in forecasting performance. You have a similar picture for the IMF index. There, PLS is again doing very well at a very short horizon, like 1 month ahead. And there the gains, especially relative to a simple, rolling conditional mean, is pretty impressive. I mean, for the commodity currency stuff, I mean, there is some evidence, but it depends on the benchmark model that you're looking at. So the commodity currency model there's a hard time beating, for example, the AR for this particular fuel price index. And interestingly, if you look at the 2 indices and focus on the Stockholm-Watson type of approach, you don't find very, very strong results at all, actually. So if you want to use like a factor-based approach, you probably are a little bit better off with using PLS regression in this context. And the question is, because of this push of using commodity currency as a simple predictor for future commodity price changes, can we actually test in an out-of-sample setting whether we can add something by using this PLS approach with like zillions of data, and can we add something in an out-of-sample context relative to just using a bunch of currencies? So what we're going to do is we're going to basically test whether an extended factor-augmented regression that includes the commodity currencies that are not included in the panel anymore with PLS factors can outperform basically the commodity currency model. And we use, again, the Clark and West statistics to do that. And you see that, again, at the shorter horizons, like 1 month, possibly also a quarter ahead, PLS gives you a slight edge of just using, lags of a commodity price change as well as commodity currencies. But it's not overwhelming, especially further out, in like 2 years out, there's not much difference between the 2 approaches, really. I mean, they're probably equally bad, if you like. Now, another sensitivity test you can do is you can add commodity futures and forwards to your set of predictor variables. The data on that is not that great, as we know. Apparently, the Dow Jones AIG also supplies you with like future indices that correspond with the spot price indices. So we use those. So basically we're going to add those to the panels and then, run the factor augmented approaches on them. And again, qualitatively, the forecasted performance are basically unchanged when you do that. In fact, if you look at the aggregate index of the Dow Jones AIG, so this is, again, the stuff without futures. You see, well, it's again, as before with the other price indices, the added value of factor augmented regressions is not that fantastic. Although PC regression here, and that's for the only price index actually in my sample, seems to outperform both benchmarks at the 2-year horizon. But then when you add those futures to the panel, basically, for PLS, nothing changes qualitatively, if you see, right? So, and even the significance of PC regression at the very long horizon just disappears now. So, that doesn't seem to help you either in really, properly forecasting commodity price changes. So basically, that's the essence of the paper. So the basic conclusion is it's just very hard to forecast commodity price changes. Although information from a big panel of data can help. So maybe that's something that we should investigate a little bit further. Policy lessons is, well, don't rely too much on commodity price forecast when making policy decisions. When you actually talk about the future trajectory of inflation and the persistence of inflation, you might want to downgrade any heroic forecast about commodity price changes in the future and their potential impact on inflation. And you should be careful if, for example, if commodity prices shoot up, that you're not too eager in raising interest rates, for example. That's the basic message. That's it. Thank you. Questions?
So of course, one point that I think is important to raise here, and that's one that is a bit of a boomerang because it hits me, given my presentation as well, is that these out-of-sample forecast tests have weak power. There's the paper by Ino and Killian that also makes that point, because you only make use of part of the sample when you do it, right, compared to the in-sample test. So. That does not necessarily mean that such forecasts would be useless for your employer, say the Fed system, depending on their objective function, or for traders in these markets there. So, for example, there's a paper in Journal of Finance by Kandel and Sternbach showing that even if you have a small degree of predictability of stock returns, very, very low R-squared, it can still lead to very large changes in your optimal portfolio positions. So is a point of a similar nature relevant here, so that you can imagine a policymaker that has a non-quadratic loss function would actually be very interested in these forecasts? And are you thinking of perhaps taking these forecasts beyond point forecast to sort of interval forecast as well, which might be very interesting?
That's probably, certainly for a policymaker, that's the most interesting part, to do density forecast evaluation, because then you take into account the uncertainty of forecasting. So, but that's a good point. Yes, Roberto.
Yes, I was wondering about the connection from the forecast of the commodity then to the inflation targeting, which is in the end ultimately what you care. So what you have showed us is that we actually have no clue about the stochastic process of commodities. What about the pass-through? Do we have any idea about that, or that was also completely as complicated as this? My experience that is as complicated as this.
Yes.
Which means that we should not pay attention whatsoever to commodity prices. That's kind of in the end.
that's true. That depends on the policymaker. I have to be very careful now, actually. That depends also on the policymaker and how they interpret those movements and how they sometimes change their view on the world because of that. I'll leave it at that, actually. More questions?
Very interesting presentation. Couple of comments. In an earlier life, Rogoff was looking at exchange rate forecasting models and came to this sort of general conclusion that at very short horizons was hard to beat very naive univariate models, like random walk. But when you went to longer horizons, sometimes the fundamentals started to help, although in many cases he was assuming you knew the fundamentals, rather than having to forecast those.
Yeah.
But I wondered, as I looked through here, there didn't seem to be any pattern where, as you move to longer horizon, things other than the univariate model started to look any better. So just
That was a surprise for me also, actually, because I would have expected something like. I mean, I've done quite a bit of work on exchange rate forecasting, and there you usually see, if you go like 3-4 years out, at least in sample, you can find some kind of connection between fundamentals and exchange rate changes. Here, actually, it kind of, if you look at the PLS approach, it's kind of opposite. Because there, if you find significance, it's like 1 month ahead or 3 months ahead. Yeah, that's a very peculiarity for commodity prices. I haven't seen that for exchange rates, for example.
And unrelated, you have some results on the Rogoff model, and you're getting quite different results. So I'm wondering, to what extent was that is this a replication exercise, or are you using a different commodity index or a more extended sample? Why were his results so good and yours so bad with that
That's a
model?
dangerous question in itself.
Yeah,
but, well, so we're using monthly data. He's using quarterly data. That's one difference. The sample obviously is a little bit shorter for him because he's going up to it's published in 2010, so it's probably going up to 06 or something like that. But he uses, for example, the IMF price index that we've been using here. So.
Well, I think
we use our monthly data, but like a similar span of his evaluation sample, and even there we couldn't really replicate entirely his results. So.
And then final comment on the commodity currencies. I'm surprised that works at all, given a related literature. When you're looking at investments in commodities, I believe it's in the Gorton-Rauenworst paper, they ask, why invest in commodities directly? Why not invest in commodity-based stocks? Mm-hmm. And they find that investing in commodity-based stocks is a very bad alternative to investing in commodities. Right. And so there's a lot of slop between having the commodity in the ground and actually making profits, right? So if you view a country as a big company, but even more amorphous, you'd expect there to even be less linkages. So if someone had designed a research project saying, we're going to look at commodity currencies and see if that helps, I wouldn't have funded that, right? So I'm surprised it works at all, given this literature. But given that it does work, then I guess I'd turn it back and say, can you use valet stock prices or prices from other companies to forecast the commodities?
That's actually a good question.
And I don't know if that would be any more or less productive. Maybe equally ridiculous ex ante.
That's a good question, actually.
If I may, I have a counter-example to what you just said. A paper in the Journal of Finance by Tufano looking at gold mining company share prices and their sensitivities to the stock market as a whole and to gold prices in particular. And the author, Tufano, who has a number of papers, illustrates that there were time periods where indeed, you would benefit a lot from being exposed directly to the share prices of companies. And let's look at the recent time period. If you had bought BP, or let's leave BP on the side, but let's talk about oil companies like Exxon and so on. You have bought it in 2001, and you have held the share price, the shares for 7 years, your return would have been very large and very much related to the underlying commodity price. So one needs to be careful. You need to look at the time period, and you need also to look at the specific commodity. So I was just mentioning to Fano as an alternative to the paper you had mentioned.
How about an investment in BP?
Yeah, but BP, you've got...
Yeah, I mean, that's
I
the
was
point.
not talking about oil companies.
Just a quick comment. I think the difference between price itself and a company is that companies are evaluated because of profits, and the cost, means a lot in this case. So, so these are very different. But maybe in the short term or in the specific period, like she mentioned, that may work, may not.
To finish,
And that, sorry, and that also may explain why you have companies digging up the earth, because in the long run, as long as their cost goes down further than the price, they can increase the profit. So.
And not to quote myself, but I'm just finishing a paper on fertilizers and investing in fertilizer-related companies over the period 2001 up to now, and your returns would be spectacular, whether you look at potash or whether you look even at smaller companies. In fact, the smaller the company, the higher your positive exposure to the price and the returns over the last decade in the case of fertilizers. So we absolutely need to talk about a specific commodity and a specific time period as well, if I may.
I think a natural question to ask here is whether we should be thinking about forecasting commodity prices or commodity returns using the same kinds of technologies we use to talk about returns on other financial assets. I mean, it's a very different methodology we would use if we wanted to know what was the expected return on some company. We would be looking at its exposure to various risk factors and how those were priced and so forth. So it might be that, and if you use this kind of technology with stock market data, you'd not be at all surprised if you didn't get anything. So maybe there are other approaches to modeling expected returns on commodities that actually should be used here, having to do with their correlations with things that investors are concerned about.
That's a good point. Yeah.
Thank you. To mention a country case where we're looking seriously at commodity currency and non-commodity, or I would call them anti-commodity currencies, I chair the advisory committee of Chile's sovereign wealth funds. And we asked a consultant to do a study to come up with a recommended portfolio for our sovereign wealth funds based on an objective, complex objective function for the government, where one of the main components was the objective to hedge against shocks in revenue which come from domestic GDP shocks or international copper price shocks, because Chile is the largest producer and exporter of copper in the world. And the government revenue is very much exposed. Actually, 70% of the variance of government revenue comes from copper price volatility. And given certain restrictions on foreign investment, what the model came up is that a large share of investment of the sovereign wealth funds should be in Japanese yen. And then we scratched our heads, and among the different options we had there, other currencies ranging from obviously US dollar and euro and Swiss franc and British pound, variable income and fixed income. The Japanese yen came out as a top candidate. The largest share should be in Japanese yen, fixed income, government bonds, 10 years, 15 years, 20 years. Because the Japanese yen is the anti-commodity currency par excellence among the top currencies, 10 top currencies in the world, because Japan is the one country which is most dependent on imported commodities. Right. The only thing which they produce domestically is subsidized rice in small rice paddies. They import everything in terms of commodity. So the Japanese yen moves exactly, or is the most negatively correlated to whatever commodity price index you have there. Now, we didn't go all the way. As this study recommended, we didn't invest 80% of our portfolio in Japanese yen for obvious reasons, but we certainly corrected, or we recommended the minister to correct, and 1 week ago, the Minister of Finance of Chile, Felipe Larraín, he decided actually to change the portfolio composition to go a bit into variable returns and significantly larger than the 15%, I think we went to 25% to Japanese yen now, right, based on this study.
Very interesting.
Any more questions?
I'd just like to get back to basics of if you're an entrepreneur and you're going to invest in an industrial activity, you need to have certain parameters for your future. What is your present value of investment, your future net cash flows? Mm-hmm. And today, as an entrepreneur or an investor, you do not have a substantive basis on which to determine your residual value, let's say, of any investment, because you have an imbalance between primary liquidity generation in the real economy and secondary liquidity generation through securitization of rights and non-monetary assets. And the control, anything you do in business, you have to have manageability of it. If you don't have manageability over the velocity of circulation of secondary liquidity created through securitization, we don't have a basis on which to make sound decisions, and even time frame decisions. So can you comment, in a sense, there must be systemic tolerance limits as to the amount of secondary liquidity you can create to feed into an economy, or the global economy, basically, before it starts literally undermining the basic purpose. And you can get very simple examples, like when your operating margin is squeezed by overproduction, overconsumption, the whole cycle of resource intensiveness, with everybody looking at it, and then suddenly you find, well, you can go and make your telephone or your product or whatever it is out in China, but hang on, what happens to the people in the producing, the original producing country, developed country? How do they generate primary liquidity in order to have the savings to buy the product that is actually made abroad?
Right.
If it all goes on to credit, there's systemic tolerance limits. My question then, in a summary, just taking that, is, can we get back to primary liquidity generation concept? As the gentleman said very ably beforehand, you need to have some basic reference point on which to start, and we're losing that. And so can we get back? Does it make sense from the central banking point of view and the commodity price point of view to get back to a consensus of something on which business can actually work on, and not be totally dependent on, whether somebody went into the stock market and bought a billion here or sold a billion there, but has to get on with the basic job of creating value, for which everybody has. I'd like some comments on that, if you could be so kind.
That's a very, very good point. Of course, I mean, throughout the world now, central banks are working hard on financial reform, and especially financial sector reform and, revamping financial regulation to, kind of address some of the issues that came up, during the global crisis of 07, 09. And we're working pretty hard on that. And I mean, that also is like a fluid process between central banks and politicians. I can't give you like a hardball number, like a quantitative measure, but certainly, I mean, from our perspective, we're working very hard in, trying to recreate a very solid financial sector and making sure that we're not going to end up in the 07, 09 type of situation again, and also the run-up to it with the, build-up of housing bubbles and bubbles in other asset markets. That's all I want to say or can say. Any more questions? No? Okay. Well, thank you very much.